Hello everyone. So this particular lecture will be dedicated towards Fama and French model. Okay, this is a three-factor model. I presume that before watching this lecture, you have the basic understanding of the CAPM. If you don't have that understanding of CAPM, first of all, watch that video of the CAPM and then come to this particular lecture. Okay. So there are basically two friends, Fama and French. They too have developed this model, I guess, towards 1990s, and with the help of the regression, okay, with the knowledge of the regression, they have done regression based on the value, based on the size. What was their belief? First of all, let us understand. Their particular belief was that the small cap stocks perform better than the large cap stocks. Small cap stocks perform better than the large cap stocks, and the value stocks perform better than the growth stock. This was their belief. But later on, when they have taken the historical data, run the regression of it, and then actually they found out that based on the historical return, the small cap stocks provide you the higher return as compared to the large cap stock, and value stocks give you better return as compared to the growth stock. This was their belief, and with the help of the data, with the help of the regression, they satisfy themselves as well as they have satisfied the world that their theory was correct. Clear? Now it was three-factor model, but I have told you two. One is the size, another one is the value. What was the other third model? The third model is the CAPM. Clear? So there are three factors. One factor is the market itself, which is captured by the CAPM model. Second factor is the size, and the third factor is the value of the company. And based on these three factors, they have designed a model and they named it as Fama and French model. Clear? And this model is used to find out the RE, that is the required rate of return. With the help of these three factors, they identify the RE. See, everyone is talking about the RE. CAPM is talking about the RE. Multi-factor models is talking about the RE, and there are many other models coming together and try to explain that what is RE. But RE is a very complex stuff. Means what is the required rate of return of a person in the market? Very difficult to identify. Clear? So everyone come up with their own theory, try to prove the theory. Some said that some models are difficult, some try to make it easy, some said the model is not relevant with the economy, they come up with a better model. Like I'll give you an example, CAPM. It consider one factor, that is the market factor, ignoring all the other factors. Clear? Some other economist and analyst came and say, see, you are taking only one factor. Might be it is not relevant, okay, it is ignoring many factors. So they have developed a multi-factor model in which they have included GDP, inflation, currency, oil prices, whatever factors you want to incorporate, you can incorporate considering their beta and then finding out the RE. Similarly, Fama and French came up with the different mindset. He took CAPM, he took size, and he took value to come up with the model of RE. Clear? Okay, so till now we have covered up these 3 points. Let us check them. The first point which we have covered is that it is an extension to the CAPM. It is an extension to the capital asset pricing model, that is CAPM. Clear? And after that extension, what we have added? We have added this value risk factors and this market risk factors. We have added two factors, value risk factor and market risk factor. Value means the companies whose book value is higher, book to price value is higher. What does that mean? Book to price value is higher. Let us understand that what is this book to price valuation. Let us take an example. There are two companies, okay, company A and company B. Clear? Its book value is 100 and the company B book value is 200. But suppose the price of these two companies, the price is 50 and over here the price is say 800. Clear? So if you'll take price to book value, that is 50 by 100, price to book value 50 by 100, that is 0.5. and if you'll take this 800 by 200 is 4. What is the meaning of this 4? The meaning of this 4 is that company price is trading 4 times the company's book value. Write down the company price is 4 times its book value. Clear? And what about company A? Its price is trading half of its book value. So that is a value stock. This one is a value stock and this one is a growth stock. Clear? Value stock means which are undervalued, whose price to book value ratio is lesser as compared to the growth stock whose price to book value ratio is very high. Clear? And why its price to book value ratio is very high? Because of the huge demand of the particular shares. People are buying a lot, and because of which its price increased, but its book value did not increase. Book value means what? Assets. The asset of the organization is still at 200. Asset is still at 200 but prices are 800. What about company A? Assets are 100 but price is still 50. Means it has a huge scope to grow. Clear? So this is our first point, that we have to incorporate value factor. Also we have to incorporate market risk factor. Value factor and market risk factor. Two friends who invented this model, Fama and French, during 1990s, and it came out of regression from the historical stock price. Means they have taken the historical price of the small cap, historical price of the large cap, historical price of the value stock, historical price of the growth stock, and then they run out the regression. Clear? Hopefully you are understanding. I have explained it in a most easiest manner. See, if simply I'll jump directly to the formula, it's not my way of teaching. First of all, let us understand the background and then we'll move ahead that what actually they did to come up with this model. Now, what they have done, they have actually created a portfolio. Okay, what was that portfolio is all about? That portfolio is a long short portfolio. Means they said that the small cap will outperform the market and large cap will underperform the market. So if it will outperform the market, they will buy it, and if it will underperform the market, they will sell it. So when you are doing buy sell strategy, when you are doing buy and sell strategy, that means what? Your investment is zero. Try to satisfy yourself. Your investment is going to be zero because you haven't invested even a single amount of money, because whatever is the proceeds from sell side you have invested in the buy side. Clear? Suppose you sold the shares of $10,000. Clear? Then immediately you bought the shares of $10,000. Clear? So it was a strategy where the investment is zero. Clear? Now similarly they have done with the stocks whose book value is higher, they went buy, and the stock whose book value is lower, they went sell. So it become a long short strategy. Investment is going to be zero. Clear? Now I tell you, if you invest your $100, you are investing your $100 and this investment is risk free. This investment is risk free. What is your return? What is your return? In this case your return is going to be RF. Clear? But suppose you did not invested anything, you haven't invested anything, but you took risk. What you are going to get? You are going to get risk premium. What is the meaning of this? You haven't invested anything. Consider it like a future option. Okay, suppose you sold an option. Clear? So there was no investment, but you are taking the risk. What you want in return? You want risk premium. Clear? And suppose there is a strategy where you haven't invested anything and you haven't taken any risk. What should be your return? Zero. What should be your return? Zero. This is where Fama and French break the records. What they did, come here, their investment was zero. Their investment was zero. Clear? This is the first point. Second point, they designed the portfolio in such a manner that the beta of small cap and the beta of large cap, this one is plus, this one is minus, and the weights were given in such a way that it will nullify each other and beta becomes zero. And when beta becomes zero, that means what? Your risk towards the market becomes zero. See, there are two ways of losing in this portfolio. There are two ways of losing in this portfolio. One is the company specific and another one is the market specific. Clear? When you are investing in the market, your company specific risk went away. Clear? But you are investing in the market, there is a market risk. Means if the Nifty or Sensex will go up and down, your portfolio will go up and down. Clear? But they have managed their portfolio in such a way that its beta becomes zero. Beta become zero, nullify, plus minus, beta will become zero. So means if the market is going up or down, nothing is happening to the portfolio. Nothing is happening to the portfolio. And at the end of the term, they found out that there is a positive return. At the end, they found out that there is a positive return. Clear? Means their investment was zero, their risk was zero, but still they are managed to get some positive return out of it. So means what? Their theory was correct, because if it can satisfy the data, your theory, if it can satisfy the data, that means your theory, your judgment is correct. So here the Fama and French break the records. What they did, first of all, they designed a strategy by buying the small cap, selling the large cap, by buying the value stocks, selling the growth stock, combined it into a portfolio in such a way that their portfolio will neutralize each other with the market. So if the beta will get neutralized, means whatever will happen to the market, my portfolio will remain intact. Clear? Now at the end of the portfolio term, they found out that they are able to generate some positive return. What does that mean? This means that the small cap really outperformed the large cap, the value stock really outperformed the growth stock, and hence here we can say that their strategy is correct. Clear? This is the point. Now there are betas, one beta which is there in the CAPM and one beta which is there in the Fama French model. If my beta is equals to 1, in CAPM, it is termed as risk free. So what is the baseline for deciding that whether my portfolio or whether my asset is in line with the market? Beta is equals to 1, then it is in line with the market. But if beta is greater than 1, then it is risky. If beta is less than 1, it is safe haven. Clear? But in case of Fama and French model, where I am investing in small cap, large cap, value stock or growth stock, over here my baseline of the beta is 0. Over here the baseline of the beta is going to be 0. Clear? So what they have said that if the beta is greater than 0, then it is a small cap, and if beta is less than 0, it is a large cap. Clear? Now this also little bit mathematical, because see what you are writing. You are writing like this now, beta S minus say M. Clear? Company with the small size, company with the large size. I am just taking my own notation at present just to make you understand. Clear? So beta is positive, it will be multiplied with this will fetch you the positive value. Clear? Now this term is negative, so what I want, my beta to be negative, so that their multiplication will be positive, because at the end what I want, at the end I want positive result. Positive result. Clear? So you can remember it like this as well, that okay, the small cap, it's a positive side, so the beta is positive. Large cap, it's in negative side, so its beta is also negative, so that we can balance it, and at the end what I want a positive result. Clear? So now if I'll write over here the formula, okay, what was that formula? First of all, required return of the stock is equals to RF plus beta RM minus RF. See, this whole part is equals to our CAPM. Clear? Then we have beta that will be multiplied with RS minus RBei. That is the company with the smaller market cap, and the company with the large market cap, plus beta multiply with RHML minus RLBM. Clear? This is RBL. Clear? HBL, high book value. This is LBM, low book value. Clear? Are you getting the point? This is the model. So this factor is CAPM. This factor is CAPM. This factor is size factor, and this factor is the value factor. So these three factors will combine together and it will give me what? RE, that is the required return on the stock. What it will provide me? Required return of the stock. So over here what we are taking? Over here we are actually focusing more on the return. Clear? What I want? The return of the stock or portfolio? What I want? Return of the stock or portfolio. So in this, the first component is the excess return. Excess return over market. Just one second. Yeah, excess return over market. This is the first point. Write it down. Excess return over market. Clear? What is this one is RM minus RF, which is coming from the CAPM. Clear? Next point is about the excess return from size. Excess return from size, that is R small, the return of the small cap stock. Now over here I am not taking one stock. Then how am I calculating this? Over here I am creating a portfolio, and in this portfolio I am putting up the many small cap stocks. Clear? And from that small cap stock I will take the average return. Average return of small cap stock. Average return of small cap stock. Similarly, I'll put up over here the large cap stock, and then again I'll take the average. So average return of the large cap stock. So R small minus R large, R small minus R large, and that will be multiplied with the beta. Clear? Similarly, in the third part, which is the value factor, over here I am taking those companies whose book to market ratio is very high, means whose book value is very high. Clear? I'll take the average return of those companies, and again those companies whose book to market value ratio is low, and then I'll take the return of them. Clear? So I have two returns. This is one for the high book value, and this one is for the low book value. Clear? And then multiplied with the beta, and then I'll come towards the RE, that is the required return of the stock. Clear? So now over here, first of all, let us understand that what is the use of introducing the Fama and French model. Clear? There is one stock X. Clear? And it's a small cap stock. So CAPM will come and say that what is the required return from this X? It is RF plus RM minus RF multiplied with the beta. Clear? But Pharma and French, they came and they say, see, CAPM, it is going to give you a higher return. This particular stock is going to give you a higher return. Then CAPM will say, why? Pharma and French will say, because it's a small cap stock, it will have additional amount of return as compared to the large cap stock. So over here you will get something extra beyond CAPM. You will get something extra beyond CAPM. So this is the use of the Pharma French model. There is one stock and there are many models are there to identify that what should be the required return from this stock. So Pharma and French is saying to the CAPM, see, you should give him some additional return. You should give him some additional return. So Pharma and French, what they did, they took the CAPM and added that component of the small minus large. Clear? And then they come up with the new required return from that particular stock X. So first of all, I have taken a small numbers and small example in front of you so that you can analyze it properly, that what is happening. Clear? This is the value for the stock X. Okay, and stock X is this is a small cap and value stock. Small cap and value stock. This is the first point. Now what I took its return minus RF. I took the return of the small cap and minus RF, and I have done the regression, Clear? What I got? I'll get the value of the beta. With the help of the regression, what I will get? I'll get the best beta. Clear? Also I get the model. Clear? There is another way of finding out the beta. Clear? But here I got the beta after doing the regression as say 1.3. Clear? Now the CAPM will come and calculate the required rate of return. So how much he will calculate? As per CAPM, it is going to be how much? Write down RF plus RM minus RF multiplied with the beta. RF plus RM minus RF multiplied with the beta. What was the RF as per the question? 3.4. Clear? Plus what is RM minus RF? RM minus RF is already given 4.8. So 4.8 multiplied with 1.3. Tell me how much? After multiplying it with 1.3, what is your return? As per CAPM, what is the required rate of return? 9.64. Okay. But over here Pharma and French came and they say, see CAPM, your return is wrong. Clear? Your return is wrong. Then they have done further regression and they found out the new beta. And these are the new beta for Pharma and French model. Clear? This one is negative 0.2. Okay, negative 0.2. So let us write the equation for the Pharma and French model. It is going to be RF 3.4 plus. What is the beta for the market? The new beta for the market 1.2. And what is the return? Excess return from the market. What is the excess return from the market? Write it down. What is the excess return from the market? 4.8. So write down 4.8. 4.8. Yes, plus. Then what is the return? Beta from SM? 0.4. Write down 0.4. And then multiplied with its return. How much? 2.4 plus again the beta of HML negative 0.2. What was its return? 1.6. Clear? Anything missing? Nothing. What was the return? The return came out to be after solving this is 9.8%. Write down what is the return. 9.8%. Clear? So what was the return of the CAPM? 9.64. What was the return of the CAPM? 9.64. What was the return of the Fama and French model? 9.8. Based on the historical data, it is proved that based on the historical data, this is an example of the historical data, and it is proved that the return from the particular stock X was greater than the return as specified by the CAPM. Why? Because it's a small cap and its book value is more than the other stocks in the market. Clear? So this is a good understanding of the Fama and French model. Only just understanding the theory and the formula will not make sense. You need to understand the background, that how this model actually derived, what was the basis behind that, why they actually came to your life, and how it is helping you. Clear? Okay, so this is the discussion about the Fama and French model. So I am keeping this much in this lecture. I have helped you with all the points which are necessary to understand in this particular section. Okay, thank you.